continue with the big brains. We have Michael Egorov, who is making it all happen, who is going to be joining for a quick fireside chat. So, are you good? Excellent, excellent. Very excited to have you here. So I was asking a lot of people for help with questions, and one of the things that people were really interested in hearing about was just your journey, how it was you got to be here today. You have a physics background, you worked at LinkedIn, NewCipher, you spent a lot of time on-chain dodging liquidations, which I don't think a lot of people know about.
Right.
How did all of this inform the initial design of Curve and where it is today?
Well, Curve started, as you remember, with stablecoin exchange AMM, right? And that was, the demand for that came really from myself using MakerDAO at that time. So I really used, didn't really like to sell crypto. And crypto was ETH. So instead I borrowed and used the funds from borrowing against ETH. And of course the big difficulty there was that there was not much liquidity for DAI, DAI USDC, for example. And you cash out something like USDC usually, so yeah, that was a problem. And so that was a demand for why building Curve. But also at the same time, I kind of played with trading bots a little bit. So really observed how this dynamics works. And those trading bots I was doing with a friend. They were not what you traditionally have. They were really AMM inside a trading bot. So, and many learnings from that inspired both the stable swap and actually the soft liquidations as well. So that's a kind of interesting thing. But there was another angle to this, to the demand for starting Curve. It was thinking about liquid staking before it was the thing, and before Curve, I co-founded NewCipher, and NewCipher has staking of new token. And the question was if you stake, wouldn't it be good to actually create a staked derivative and being able to enter and exit out of staking? So and that requires AMM, which is also stable swap. So that also was inspiring it quite a bit. Right. So that was why it really got started. And at the same time, indeed, since 2018, I do use CDPs and had lots of observations there, and was scared of liquidations all the time. Especially with ETH at the end of 2018 when it dropped to I don't know, $85 or something. So yeah, that was scary. That position had $83 liquidation price. So but instead of repaying, I actually bought more ETH, and it was the bottom. And later on, I used that ETH for basically very early funding of Curve when it grew up a little bit. Right, so right. That was nice, but scary to have those scary hard liquidations. So.
But you actually just suffered your first hard liquidation just this week, right?
Oh yes, well that was ironically on Curve, and it was on purpose because you actually can change how big is your range you put liquidity in. The bigger the range is, the smaller LTV you can do, but the less of a risk of this hard liquidation you have. So I've made a small position, made it in the most risky way, where it's very narrow. So it probably would would be fine if you just want to avoid like next day liquidation. If you, I don't know, go to sleep and the prices drop, and it actually worked. It didn't liquidate me at that time, but I didn't repay after. And when the price was going up, it was deliquidating and experiencing losses during that process expectedly. And well, then it was a hard liquidation there, but that's fine. I wanted to test how it works. Well, I saw it happening to different people, but like probably should have tested myself. So that's what I did.
But it wasn't the giant stash; it was just a tiny position, right?
Yeah. Well, relatively, yeah. So it wasn't like a super big stash, but yeah. Well, Liquidator got quite nice profit, and I would say loss from liquidation percent-wise was lower than in other protocols, so it worked all nice.
And that's something people don't actually understand a lot, is that it's oftentimes on the price going up that you can get liquidated due to the trading fees, not due to the price.
True. Well, the thing is, as you go through this liquidity, which you put in for like collateral, so you put collateral as liquidity, right? And this liquidity gets used when you have reversible liquidations and deliquidations. And every time it gets used, you do experience losses. You kind of, if price suddenly jumps up, the losses are just as high as if it suddenly jumps down, only if you've been in this soft liquidation mode. So if you were not in soft liquidation mode, doesn't really matter how quickly the price changes, the price of collateral. But if you were in soft liquidation mode, so you already kind of presumably in a bad situation, but you better keep an eye on your like health ratio and repay the position a little bit, so that helps you to avoid hard liquidation. Or maybe you want to repay it entirely if you got into the price you didn't expect. That's also something.
Right. And we're workshopping a better name than soft liquidation, by the way. So if anyone has ideas, you're not actually being liquidated, so it's a bit misleading. But it is the case that that when you're in that soft liquidation mode, you can get like right up to the line, it seems like. And you chose to design CurveUSD to be over collateralized.
Yes.
But do you think that you could have actually like dropped that line even closer to make it more capital efficient?
Well, not really, because like if you put it right at the border of this range, then your LTV, which you are allowed to do, is basically based on the value of stablecoin you would get if the price slowly goes down to the bottom of this range, which will be something, well, still less than 1. Let's say if the range size is, I don't know, 10%, then this would bring you, 100% minus 10% over 2, 95% LTV. But you also need to leave some room, because you actually don't want to get hard liquidated right away. Like you don't want a tiny loss to cause hard liquidation. So we add a room of 3% to that. So then you are basically down to like 90% or 89% maximum LTV. So that's what we have. And for different assets, it probably should be different. Like if something more volatile, should be probably lower than that. So you don't want the system to be with bad positions, which somebody could liquidate, better loss to the liquidator, but who would do that, right?
And at the moment it's about 9x leverage that means you can do?
Yeah, I think it's 9x maximum.
Right. And you've talked also in the past about wanting to introduce like Curve LP tokens, perhaps later as a collateral, but like much reduced. And we've seen some presentations on endogenous collateralization, for example. Is that what's going through your mind with that?
Yeah, well, the LP tokens I thought of were 3 crypto LP tokens mostly. So let's say like USDT or ETH BTC or USDC ETH BTC. So then it would be backed by this volatile collateral, I would say. But it's less volatile than ETH or BTC, so LTV probably could be a little bit higher. So that's, but yeah, this is still something external to the system. So it's still like crypto or crypto fiat essentially.
But Curve ETH might be more risky.
Curve ETH, yeah, one needs to think about it. I think it's still not getting into this territory of being like endogenous or exogenous, how it's called, yeah. So it's still it's a little bit different. If you imagine one curve ETH backed by one curve ETH, one curve USD backed by one curve USD, it actually cancels out. So you kind of change nothing if you deposited one curve USD as collateral and borrowed one curve USD against that. But nobody would do that, of course. But that's a nice model to think of if you have a pool which contains curve USD. But still, it needs to be done really carefully. So I didn't really think too deeply about pools which contain curve USD as collateral. So that's. But yeah, well, I think after good thinking, it's possible, and the thinking is exactly this, that Curve USD kind of cancels out. And I think the peg keepers do kind of that stuff, because they back, when you have peg keepers getting funds, they back essentially some Curve USD implicitly by LP tokens which contain Curve USD, and it's exactly like that. Curve USD cancels out.
Right. And it does seem like the peg keeper mechanism, which is like very innovative. It seems like that a lot of the construction of Curve USD was designed with this idea of keeping the peg as tight as absolutely possible.
Absolutely, yes.
And in doing so, I've been running some basic simulations, and it's still early days, and then I'm often looking like CoinGecko data, which is not ideal.
All right.
But it's still showing like as tight of a peg as a lot of the one-to-one backed redeemable stablecoins.
Yes.
So then the trade-off there, I guess, would be the borrow rate.
Right. Borrow rate depends on how much you have in peg keepers. It incentivizes to have something, but not much. If peg keepers get too much, borrow rate gets really low, like below 1%, which we've seen. And if peg keepers get empty, right now they are, the borrow rate gets to some preset value, which is for staked ETH collateral is 10%, which is a lot. So this and the reason is that if from this point, when peg keepers are empty, CRV-USD starts going down, we need some people to buy CRV-USD to essentially repay the loans, because then CRV-USD will go back up. And my original thinking was that this mechanism would be slow, because that's what we've seen with MakerDAO. It was maybe taking weeks to be like for the rates to affect the peg. For some reason, in Curve USD, it's acting much faster. So I've seen like it was maybe few hours after which the CRV USD price started being significantly changed because of rate going up. Right. And rate went up exactly for that reason, to actually try to stabilize CRV-USD when peg keepers are empty, and just works a little better than I thought, which is a surprise. So maybe that's just because there are people who actually actively look at borrow rates and maybe arbitrage borrow rates. So those people who arbitrage borrow rates between different platforms, they jump in and out depending on the borrow rate, and price very quickly reacts on that. So maybe that helps a lot, and it's kind of low risk thing to do for them, because the price of CRV-USD is actually pretty close to one.
Yeah. And I haven't got a chance to publish it yet, but it does look like the incentives are working in terms of you see the rate of change of TVL just whipsaw depending with changes in borrow rate. So.
Yeah, it's pretty exciting to see that system actually works as intended.
Yeah, I mean the whole design is like really relying on user incentives. Like I don't think many people know that they themselves can call the peg keepers to update.
Yeah.
make money in the process, right?
Well, yeah, not much money though, because
Made like
there is a
$5?
competition already. Well, so I think usually it gets called just, well, when the profit is just above the gas spent, that's what I think arbitrage traders do. So.
And arbitrage traders are really responsible for all the trades that keep it in peg.
Yeah, absolutely.
So it's what else have you learned from kind of deploying this year? You're famous for testing in prod. So you tested a few times and had to relaunch based on what you learned.
Right,
Now that's
right,
been
right.
tested in prod for a few months, what have you learned that surprised you?
Well, I think the biggest surprise was this, that rate incentives work much better than I thought. So that's a good one. I don't know if it will be like that when it scales up. Well, another surprise was that rates actually jump around very quickly. So that's not something I necessarily expected, but that makes sense. So volatility of stablecoin price, which would presumably come from volatility of collateral, actually gets absorbed in the volatility of the borrow rate.
Is there thought that the volatility might decrease as like the overall scale increases?
Possibly, yes. Yeah, and I think the thing is that if demand for stablecoin increases, then it will start. Well, if there are no borrowers who generated this stablecoin, it will start feeling that from peg keepers, and when that happens, then rate goes down, and then there will be more borrowers, so the rate will equilibrate somewhere, and yeah, and I think right now it jumps around because it's the borrowing demand sometimes becomes pretty high. So, well, this week, well, no, not this week, was it? Yeah, so at some point there were like I don't know, like weekends, right? And on weekends, not many people borrowed, but at the same time, demand for CRV-USD went up. Maybe after Thursday, so incentives changed, right? And then after that, people saw low borrow rate, and on Monday, for some reason, many borrowers start borrowing on Monday, so they borrowed really a lot, and it was comparable to to how much is in peg keepers, so it really changed borrow rate a lot. So there are some these kind of artificial time limits, which like what people do on weekends and what they don't, which apparently affects the borrow rate. But it changes like really quickly, I would say.
So we're still dependent on TradFi a little bit.
Yeah, we are dependent on TradFi a little bit, I think, or maybe on just people's behavior, really. And but I think as soon as the amount which people will probably borrow in one day will become smaller than, I don't know, 5% of total borrowed, for example, then maybe the rates would be a little bit more stable.
Yeah.
So that's what I think.
Yeah, let's talk a bit more about the scaling. So you've mentioned that by the end of the year, you're hoping, if market dependent, we get to $1 billion. Well, we'll see, right?
Hoping, yeah.
We can't predict next week.
You cannot predict at all.
But what happens if it gets bigger than that? What if it gets bigger than Tether, USDC? Would the peg keepers still be able to function when Curve USD was dominant?
Yeah, I think at the moment peg keepers assume that the amount of redeemable stable coins in peg keepers is maybe around 5%. So maybe we would have a problem if it becomes 20 times bigger than Tether, which I doubt we will see that in the nearest future at all. But yeah,
we'll see.
It's just a very hypothetical question.
Yeah, of course. Anything else on Curve USD while we're on the subject? Because I'd like to talk also about like TriCrypto NG and some of that. But any final thoughts? I'm sure we'll get user or audience questions on it too.
Yeah, I think that those were good questions.
Okay, that's good to hear. Good to hear. So let's circle back to back in the V1 days, and a lot of the inspiration for the V1 algorithm was just the slippage question, right? It was very tough with the kind of classic X times Y equals K formula to be able to do large stablecoin trading.
That's right.
It just wasn't optimized. So you went to the drawing board and you came up with the V1 algorithm.
Right.
And then from there you said, well, let's also rebalance the liquidity internally and came up with the V2 pools. And that's been going fairly well. But at the moment, like, that's not yet flippening like the Uniswap V3, right?
Right.
Because
well, I mean, it's
you're paying to rebalance.
yeah. It's and it probably shouldn't, because you, if you concentrate liquidity, you necessarily increase impermanent loss, and as soon as you rebalance, your impermanent loss becomes permanent loss. So, and let's say if you squeeze liquidity to, let's say, a 1% range, you maybe amplify your impermanent loss by a factor of, I don't remember, 200, I guess, right? So, and you hope to get compensated for that by fees, but actually, if you keep just concentrated liquidity, you don't. You actually need some of liquidity being concentrated and some of liquidity being non-concentrated. Maybe you can do some smooth transition between concentrated and non-concentrated liquidity, and that's what we do. But very briefly, you have a combination of concentrated and non-concentrated liquidity, and if the price is well, not far from what it was yesterday, right, then concentrated liquidity is working. But if price jumps and somewhere far away, then maybe you have non-concentrated liquidity working. And if you had no unconcentrated liquidity, then if price jumps away, then you don't earn fees anymore, because you don't have any liquidity. And if you didn't earn enough fees in the past when you've been in concentrated liquidity, then you just cannot move to the new concentrated liquidity to the new region without a loss. So, and the design choice was to basically keep both concentrated and non-concentrated liquidity, and the fraction of concentrated liquidity is actually not very large at all. So, but nevertheless, it's enough to keep low slippage within, like, I don't know, 1% from the current price or something. But if volatility hits, then you sometimes in concentrated liquidity, sometimes not, but always making fees to move concentrated liquidity there.
Right. And it still blows my mind that the V2 pools have their own internal oracle just based on the understanding the trading behavior and finding the price oracle and price scale. Could you talk a bit more about that mechanism for those who aren't familiar with it? Right.
So there are two prices there. One is normal price oracle, let's say exponential moving average, right? But there is another which we call price scale, which is somewhat mysterious, right? But actually what price scale is it's just the price where the concentrated liquidity sits. So when price scale changes, it just means that concentrated liquidity moved, and that is the price at which you have lowest slippage. Right. And ideally, you want your price scale to follow the price oracle as quickly as possible. But also, there is a problem though. If you make your concentrated liquidity huge, then it will be too expensive to move it around. So you will not earn enough money to move it without losses, and it will just be stuck somewhere if it is too large. If the concentrated part is too small, then of course you can move it around very cheaply, and you can always earn enough funds to move it. That's fine, but then it will be not really helpful because if it's too tiny. So crypto pools try to find a balance in between, which is sort of optimal between the two. But on Uniswap 3, if we go back to that, you have like only concentrated liquidity, so it's up to you how you manage it. In principle, probably it would be possible to implement Curve V2 on top of Uniswap 3, or maybe Uniswap 4. But my feeling is that if you do that, the swaps would be extremely super expensive when it comes to rebalances and tracking all the information which is needed. Because like if you do it like really on the low level in the on whatever smart contract language, then I think it will be always cheaper than if you go over the abstraction layers.
Interesting. So let's also talk about something that sits a little bit outside stablecoins, which is the VE-CRV mechanism, which back in its day everyone laughed at it and then everyone adopted it. But back then you were building it off of like I think Viper 2. Brownie was still in a nascent state, and there's been a lot of improvements to Viper that have allowed for some of the more recent innovations. So if you were rebuilding VE Curve today, is there any changes you'd make?
Well, I mean, of course, there could be really like switching to new compilers, of course, helps. Yes, but maybe some code refactoring also wouldn't really hurt. Well, what would be? Well, I think there is some innovation actually happening in VE space. So some different projects tried different things. Well, there was even idea to do like the NFT kind of position. Well, I don't know if it's a good idea or not, but well, it's an interesting experiment nevertheless. But yeah, I think it's probably would be fairly similar to what it is today. I think it's because I tried to make it as minimal as possible so that not much changes are needed.
Right. So I got a lot of questions about some like other protocols and your thoughts on them. So first up, Go is launching their stablecoin, and there's been a lot of questions, just like your take on Go and what it's going to do for the Aave ecosystem.
Oh, yeah. I mean that's a reasonable step, given that they had liquidations covered. They should have them mastered, right? They have all like sorts of collaterals and systems for like risk estimation and onboarding, offboarding collaterals. So it's a very logical step for them to do a CDP. And in principle, stablecoins they give all the interest earned to the system. So that's a nice income for the DAO, I guess. It makes sense.
What about Balancer? People are oftentimes using Balancer for like their boosted pools or their like imbalanced 80-20 pools. Is there any thought that Curve might start launching similar type features atop their pools?
Oh, you mean the pools which have non-equal balance, right?
Right.
Yeah, makes sense. Actually, like we usually don't try to copy the like inefficient things. Like constant product is not capital efficient, although it's very fundamental. And what Balancer does with those pools, they are also not very capital efficient, but they're good as a reserve kind of thing, or like rebalancing portfolio. But one thing I've seen very interesting, which I couldn't really come up with myself, is what YEarn is doing with YETH. They actually found how to make stable swap, keeping not 50-50 mixture, but any mixture. So essentially what Balancer does for constant product, they managed to do to stable swap. And that's actually a very interesting approach. So probably doing something like that would be curious.
Interesting. Just a couple of quick questions before we open it up to the audience, mostly on the subject of decentralization. So I don't think actually many people know this, but Curve is extremely decentralized to the point where you've never even met most of the core team. Is that right?
That's right.
Yeah. It's also, for developers, it's like a developer's paradise because there's no PMs, no meetings. Everyone's just coding, right?
Yeah, that's right.
So is your thought that you'd like to kind of like follow the Vitalik approach and like scale back and let the community take it over more? Because 99% of the innovation is coming from your brain, right?
Yeah. So probably that would I still have some things to bring.
Is that alpha you can leak?
Well, I mean, not. Well, just some ideas. So it's basically when you build something, it's you almost immediately think about something else to create, which is not necessarily always huge, but requires some effort, and it's hard to resist to not do it.
Okay.
So.
Okay. Interesting, interesting. Do you think more companies are, and like within Web3, even this kind of developer-centric structure of a company is still fairly rare. Do you think that, like, but it's working for Curve because you have about a dozen people managing billions of dollars in assets just through writing code alone. Like, do you think that's going to become more the model for successful Web3 companies?
Possibly, possibly. But I think it's just whatever works for different companies.
Yeah, makes sense. And then I guess finally, before we open to the audience, like, just what are your predictions for like DeFi, cryptocurrency, over the next 3 years to 3 centuries, which is roughly the emission schedule for Curve?
Okay. Well, I guess for 3 years, it probably would continue as more or less as it goes. Well, interesting to see that regulators started noticing crypto. Well, maybe that's good, maybe that's bad, who knows? But they do notice, and because they feel it's probably the future, and they of course try to regulate. And well, who knows? Maybe natural ways of self-regulating are good, but I think this kind of regulation versus self-regulation and how it will interact with traditional systems is probably something we will see in some coming years. But as for distant future, I do think that this is the future of the world economy. So I think that well, everything will be DeFi at some point.
I agree. And on that subject of regulation, you've basically said smart regulation would be welcome. The problem is a lot of it's not very smart, right?
Yeah. But you know, many regulators are non-malicious. Maybe they are just not always very educated, but they have sometimes right goals. So, and sometimes community has the same goals. So, well, ideally, they probably should watch what community is doing, learn, and yeah.
Yeah, but being in Switzerland, the laws there are much more clear and have allowed you more of a framework to actually launch a lot of this, right?
Yeah. That's part of the reasons why I'm there. It's well, still definitely far from being all clear, but they seem to be moving in the right direction. That's good.
Excellent. Well, thank you so much for your time. Like every time you do an interview, I just learn so much. So it's such an honor for me to get the chance to talk with you like this. Let's open it to questions. Are there? I see right there.
Right. Uh-huh. Yeah, I think they are learning at the moment, so it's pretty much research, and like whether they will launch at least this way soon, well, remains to be seen. But what I find interesting, there are two kinds of CBDCs. One is something you see in China, which to me feels like not like CBDC. It feels like some state-owned PayPal essentially, and or well, many pilots on Hyperledger seem to be that way as well. But also there is something they are doing on Ethereum, which is obviously happening with Mariana. Well, they use EVM codes, so, and that means that this is another kind of stream in CBDCs, but also this Mariana project seems to be focused on large organizations, banks, like basically big guys. So it's doesn't seem to be something like consumer oriented. So, and that also makes sense and kind of hopefully alleviates some CBDC concerns people may have, like about surveillance and whatever. This is not something. I think this is not that kind of CBDC over there, but maybe we'll have two types. Who knows? So it's they are still exploring like what to do, and I think they all started with CBDCs like PayPal and something running in like super confined environments, not very decentralized. And this project Mariana, what I think is interesting there is that they seem to be running on Ethereum. They deploy an Ethereum testnet, so maybe that means that they become more receptive to using something like public blockchains. Hopefully, I don't know. Like, don't have any hard indications about that, but that's what it seems.
Given that Swiss State owns the intellectual property for the Curve V2 algorithms, would they be obligated to at least compensate you for this use?
Well, I guess, but that remains to be seen. They are doing just research at the moment.
Right.
It's not really used right now, but they are just trying to see like how applicable would be different primitives to their goals. Yeah. But well, I mean, something is possible, but in which way? I think it remains to be seen once they get to probably next steps, and when those happen, I don't know, because it's like really their research essentially.
Right, of course.
Obviously, there are a lot of different stable coins, different models of those. Thanks for that. So yeah, obviously there are a lot of stable coins, different models of those. Like they are fiat-backed, decentralized. Even in decentralized world, there are different approaches to how you can build it. More capital efficient, less capital efficient, more decentralized, yield generating, etc., etc. Do you think the landscape will be that there will be a specific market fit for each of those types, or it will be just a world, there is one stable coin, or like one fiat-backed, one decentralized? What's your view on that development?
Right. Well, I mean, Curve initially was formed on the idea of having multiple stable coins. So I would hope there would be many stable coins, really.
Could you say a little bit more about what you think it'll take for stablecoins to get to hundreds of billions or trillions of dollars of market cap, and if maybe talk about it in a phased approach, right? So like if that's the medium-term aspiration, how do we practically get there? What types of innovation do we need to see? What type of primitives need to be built to support that? Like, how do we get to that goal?
Yeah, very good question. I think what we really need is exchanges to expand. Exchanges for stablecoins to expand from just crypto market to foreign exchange markets, and for that we need stablecoins of multiple denominations. We actually do have that. We have several euro stablecoins, so that's good. But also it means that liquidity should be bootstrapped. And question how to bootstrap liquidity for foreign exchange is a very good question, because like for foreign exchange to work really efficiently, you need to have access to really good foreign exchange markets for arbitrage trades. So arbitrage is actually bootstrapping markets. Crypto arbitrage is very efficient, even between decentralized and centralized exchanges. Foreign exchange arbitrage would mean access to those same markets which banks have access to, and I don't think biggest arbitrage. Biggest market-making firms have, at least connect those markets to crypto stablecoin markets. So, and that's, I think, something which needs to happen for stablecoins to scale further.
Yeah, I have the mic.
You win.
So yeah, I recently tried CRV-USD. I'm a big fan already. But like what I've noticed, a lot of stablecoins, they still go to this like fiat-backed paradigm, which I don't know. Me personally, I find a little bit maybe suboptimal because of recent like bank collapses and stuff, and like how unstable the global financial system is. I was wondering, what do you think about unpegged stable coins like RAI, HAI, and could Curve be exploring that direction?
Well, that's an interesting question. I think it makes sense in principle, but I don't think it has much utility because you cannot really redeem those or peg those to something you expect to stay stable. Maybe something like a stablecoin pegged to gold makes sense in principle, but I think still not very easy to bootstrap the demand for that. So, but on the other hand, if you borrow USD against crypto, you are actually shorting USD. So you are betting against the I don't know against the stability of financial system. So if you can imagine that USD goes to like to zero because I don't know because of some because the US economy gets mismanaged and whatever, then that's good because you will have to repay less, all right? So you can think that way if that makes you more comfortable, I guess.
Hi. I have a question because we talked about CBDCs, we talked about decentralized stablecoins, etc., etc. But we are seeing regulators coming in more and more. And so if they recognize stablecoins, it basically means that any private company can issue stablecoins. And we're seeing a lot of interest as well from actors like BlackRock, Fidelity, whatever, for the crypto sector. And so my question is, do you think that we can see stablecoins, not like CBDC-like, but something close to it, which could be issued by these actors? And do you think that is something that could be integrated within the current markets easier than the CBDCs?
Yeah, I think absolutely. I think also, well, I've heard that these are called deposit tokens, right? So tokenized deposits. And they, I think they make a lot of sense because you have risks of essentially one company in one token. So if you are into combining many of those into diversified baskets, then they actually make a lot of sense. I'm not sure if they make a lot of sense for like end user, but they make a lot of sense for these diversified portfolios and making like resilient, like other resilient stablecoins. So that's what I think.
All right, so I'm sure there's a ton more questions. The good news is Mitch is here in the premises, so feel free to ask him afterwards. But we're going to move along to our next panel, which is going to be hosted by Krzysztof Urbanski of L2B. Everyone thank Michael for throwing this whole thing.